Wealth. I'm Kevin French, and we are going to be covering what happened in the month of December. This will be our last monthly wrap-up for the year of 2025. So the month of November was another positive month for global equity markets. We saw them rallying towards the end of the month and finishing marginally positive. The big standout, however, was that we saw a number of the tech stocks and the Mag 7, as they're called in the US, actually coming off during the month of November. I'll touch on this a little bit more later on. So while we've seen the stocks in the US, the tech stocks coming off, we've seen some rotation out of those into your healthcare type stocks, which have been neglected for a fair while now. Emerging markets were a little bit softer during the month, but are still up significantly over the year, up over 30% year to date. The US government ended its longest shutdown ever, some 43 days, which ended on the 13th of November. The government has now approved the spending plan, but only to the end of January. And they still have to work out the longer term spending plan, and hopefully they'll be able to do that by the end of January. This has had the effect that a lot of economic data that's produced by the government has not come out, and so investors have not had the data at their fingertips to be able to make some decisions going forward. On the back of this, we've seen the US dollar during the month weaken further by some 0.3% against a basket of global currencies. In South Africa, we've seen for a number of years that foreign investors into our bond market have not had a great appetite. However, that has changed. This increased demand in our South African bond market has seen the 10-year government bond yield come down to 8.4%, its lowest level in some 8 years. This has seen our bond market as a whole give some really attractive returns, almost double what we've seen in the emerging market peers so far. Sentiment is improving towards South Africa. What I've just said is evidence of that. And we are seeing improvements. For example, we've come off of the grey list. Some of the credit ratings are starting to improve or give us higher credit ratings. And all of these things are adding to that positive sentiment that we've seen in 2025. So if we have a look at how this news is fed into the markets globally, we can see on this table here that year to date, we've had some really strong returns in equity markets. Developed world equities up over 20%, emerging market equities up close to 30%. Japanese equity markets, although it had quite a pullback this month after a really strong last month, is up 29%. European equities up over almost 30% as well. What's interesting, if we have a look at the 1 year number, we can see that it wasn't America driving these global markets. Although the American market's up 15% for the year, European equities 29.6, UK equities 26.6, Japanese equities almost 29%. The world has started looking at other areas other than the US stock markets. If we have a look over the longer term, some significant returns over the last 3 years. So it hasn't just been this last year. And we can see there global equities in developed markets 19.1, emerging markets still an exceptional return at 14.7 over the last year. If we have a look at the South African markets, we can see over the month of November some exceptional returns. Equity markets return very good at 1.7, but actually looks quite mediocre compared to listed property markets and our bond markets, giving some exceptional returns on the back of that demand that we spoke about just recently. The year-to-date numbers over 30% in the equity and listed property market. But the point I'd like to make is if we have a look at the 5-year number, South African equity markets almost 19%, listed property almost 24%, and inflation over that 5-year period some 5%. If we have a look at the 10-year number, so this includes the period of the Zuma years in South Africa. Equity markets giving you 11.7 and inflation tracking at 4.8. So that gives you a 6.9% real return, 6.9% above inflation. That means that the last 5 years have actually caught up a lot of that underperformance we saw during the Zuma years, which means that investors who stuck in for the long term have been well rewarded with real returns on their portfolio. We're going to have a look at our South African models to start with. And I've got a bit of grief from one or two of you who have teased us about always bragging about our returns. But suffice to say, if it's green, it means we've outperformed. If it's red, it means we've underperformed the class average or the peer groups. So yes, we've had some really good returns. But I want to talk to you about something called the Rule of 72. The Rule of 72 says that if you take your return and divide it into 72, it will tell you how many years it will take for your return to double. Now, if you take our core wealth balance strategy or our retirement growth or our flexible strategy, even our recurring income growth strategy, over the last 5 years, the return that we're showing you there, so 15.9% in the case of retirement growth, investors who were invested in that strategy, whatever they had at the beginning of the 5 years has now doubled, more than doubled in fact, at the end of the 5-year period. So let's have a look at our sterling models. These strategies are now into their 5th year. Since inception, returns of between 1 and 1.8% better than the peer group or better than their class average. So we're happy about that. And the last year has been a particularly good year as well, between 1.6 and 1.9% ahead of the peer group. If we have a look now at our global models, but looking at the world through a US dollar lens, we can see here these strategies are now in their 10th year that they've been running. And we can see that this last year was really good, and that was particularly on the back of our underweight exposure to the US equity markets, and our emerging market exposure has helped us particularly in those strategies. But again, since inception, over the longer term, between 1.5 and 1.7% ahead of the peer group. Over the last 5 years, it's been even better than that, so something we're particularly happy with on the global side. So for the last number of years, artificial intelligence has been very impactful in markets. What we'd like to talk about today is the case for Chinese artificial intelligence, and is there something we should be understanding about that market? So if we start off by having a look at this table here, which measures through different surveys that we've listed at the top there, the readiness of a country for artificial intelligence and it having a positive impact. So the top 10 basically of that list are countries that are doing well, and you'll see they're mostly developed world countries, the US at the top and China in second place, although China's an emerging market. But most of the countries there, you'll see Singapore, Canada, the UK, Switzerland, Germany, etc. But then as you look at the bottom of the list, it's mostly emerging market countries. South Africa, unfortunately, one of the poorer ones in terms of this survey, but also countries like Turkey, Mexico, Brazil, all emerging markets at the lower end of this. And that's really because of the infrastructure and the environment that you typically see in a developed country, where there's lots of capital that can get invested into artificial intelligence research and development. The fact that China, an emerging market, is second on this list tells you that there's something there that we should be having a look at. China has been neglected a little bit over the last number of years. They had the property bubble there, that burst, economic growth slowed down, so resources were used less there was less demand for it. However, we've started to see that change, and we've started to see how different countries are appreciating that China is more investable now. However, if we have a look at these two graphs, the one on the left just shows you a country's opinion of whether China is more or less investable than it was, the blue dot being 2024 and the red dot being 2025. And you can see they've all moved further to the right, indicating an improvement in their opinion of whether it's favorable to invest there or not. On the right-hand side, it's just a graph just showing high-income countries that have got a favorable opinion of, in blue, the US, and in red, China. And you can see after COVID, or just before COVID, the favorability opinion dropped off significantly, but actually the two are now converging and they're getting pretty close together. There's a lot of research coming out just suggesting that China, the companies in China are well positioned to adopt AI into their businesses, and that could add between 0.2 and 0.3% to their GDP or their economic growth over the coming years, and that could be in place by 2030. In any equity market, there are local investors and there are foreign investors or global investors that will come in and buy shares in a country's stock market. What we've seen for a period of time was that there was perhaps a bit of a slowdown in the demand from Chinese investors. This graph just shows us two things. One, it is showing the GDP growth, which is the blue line, and the red line is money supply. Now, money supply is just an indication of how much money is moving through the economy, and essentially here we are seeing that every time money supply picks up, it typically has a positive effect on economic growth. And we are in a period now where there has been some significant increase in what they call M1 money supply, and there's further expectation on the back of that we'll see more economic growth and improved equity performance as companies take advantage of that. I mentioned earlier that adoption of a technology is very important and critical to how impactful it will be in an economy. And we've seen a number of the large banks in China committing and starting to implement artificial intelligence into their processes and how they're running, which again will make them more productive, and that will have a knock-on effect to their profitability and the impact in the economy in China. But what we're showing in this graph here is just the different providers of large language models, but just showing you that the Chinese language models are not far behind. They're keeping up, and one of the distinct advantages that we're seeing from something like DeepSeek, for example, is how much cheaper it is to actually run it in terms of computing power, etc., from behind. So something that again shows you that the Chinese AI industry is in a healthy position. Lastly, I just want to touch on the stimulus to get artificial intelligence going and growing. So China has essentially got a government-led investment strategy or stimulus strategy to get artificial intelligence growing, and in the US it is more private sector led. But what we can see on these two graphs, on the left hand side we can see the percentage of GDP that is spent on research and development in the different countries, and you can see in the US it has the most, and that's coming from the private sector. But China, the red line, interestingly on there, it is catching up strongly, and the gradient of that graph, in other words, how quickly they are growing, is basically the strongest out of all of the countries that were surveyed there. So again, further evidence that there's strong impetus in the second largest economy in the world to get AI off the ground and have it making an impact. And then lastly, on the right hand side, the blue line is the price earnings ratio of the tech industry in the US, and the red line is in China. And the higher a price earnings ratio, the more expensive a share is considered to be. And we can see there that basically the US tech market trading at 39.4 times price earnings ratio, whereas in China you can buy similar stocks for half that price, 19.5 times price earnings ratio. So again, another attraction of the Chinese market. It's a huge market, but it is also trading at a much cheaper level. So further impetus for investors to invest there. So we have an overweight position in many of our portfolios to the Chinese economy and stock markets, and that's some of the thinking that has driven that overweight position, and it has paid off well for us, but we expect to see further reward for investors from that position into the future. So we've come to the end of 2025. It's been a good year, both in absolute returns and in relative returns. We would just like to say to our clients, thank you very much for your support and being clients, and for the many referrals that you give us to your friends and families. We're committed to continually offering sensible and intelligent advice that grows your wealth over the longer term. Those of you who celebrate Christmas as I do, I hope it's a blessed time of year and that you have a great time with family and friends. For those of us who are traveling, travel safe, enjoy your time, rest, recreate, and come back ready for 2026 with even more vigor than we had in 2025. God bless. Goodbye.